Welcome back, and here we go again. Recently, a Wall Street Journal report came out that said that PayPal is in negotiations to sell itself to a group that includes Stripe and the private equity firm Advent International. Back in July, these potential buyers offered $60.50 per share, and PayPal said that the offer was inadequate. But apparently, the talks have continued since. I never personally gave up on PayPal. I've owned this one for a while and actually most recently bought more of the stock in February at $44 per share. Holding the stock has been a wild ride, often surrounded by negativity, much of which I would argue has been due to the stock price performance and the perception rather than the reality of the business fundamentals. Does PayPal have issues? Sure. But are those issues as severe as either the stock price or the commentary surrounding the company has often implied? I would argue no. As a shareholder, when it comes to any potential buyout of the company, I have thought about what price I would be happy with. And I'll be honest that I'm obviously going to be biased because I do have shares and 2028 leaps on PayPal. But I think I can also try to be objective, model out a valuation for the company, and think about what might make sense while considering that a dollar today is worth more than a dollar tomorrow. In this video, we'll look at why Stripe and Advent may want to acquire PayPal and what the company's most recent results tell us about the business. I will also examine PayPal's turnaround plan, cost saving initiatives, and their capital allocation before sharing my most recent valuation model for PayPal stock and giving my opinion about what a buyer should have to pay shareholders today. All right. So, why might Stripe and Advent want to acquire PayPal? There are some areas where Stripe and PayPal offer products that directly compete with one another, and there are others where they do not. And Stripe could actually add to its product offerings by acquiring PayPal. Even for the overlapping products, acquiring PayPal would allow Stripe to take out a competing business, lowering competition for its services in the marketplace. Maybe the biggest example of overlapping products is in enterprise payment processing, where PayPal's Braintree competes directly with Stripe. Another notable example of overlap is an accelerated checkout, where Stripe offers Link and PayPal offers Fastlane. A third example is that Stripe and PayPal also compete in services for online marketplaces. For example, when a customer pays through a platform such as a ride sharing or vacation rental marketplace, the platform may keep a fee and send the remaining money to the driver or the property owner. Stripe Connect can manage that entire payment flow, while PayPal's Hyperwallet focuses primarily on sending the final payout to sellers, workers, and other recipients around the world. One more area with some overlap is that Stripe has built out stablecoin infrastructure through its acquisition of a company called Bridge, but PayPal already has its own branded stablecoin, PayPal USD, along with a large consumer network through which it could potentially distribute that stablecoin. And that gets us to probably the biggest thing that Stripe would add to its business by acquiring PayPal, and that's the consumer network. So PayPal has 439 million active accounts, including consumers and merchants, and they have 228 million monthly active accounts. PayPal also has the PayPal digital wallet, the PayPal checkout button, which is the branded checkout part of the business that has often received scrutiny in recent quarters. They have Venmo for peer to peer payments, buy now, pay later products, and debit cards as well. So, when you think about the benefits that Stripe would be getting for acquiring PayPal, I think it's important to consider this. What would it cost Stripe to build out all of the consumer facing infrastructure in terms of both time and money? You also need to consider how difficult it would be to get customers with an existing PayPal or Venmo account to switch to a product that Stripe created. What are the consumer acquisition costs there? And those questions are entirely in addition to the significant benefits that Stripe would receive in taking out a competitor to its primary enterprise payment processing business model. That does not mean that any acquisition price would be justified, but I do think that the price should reflect PayPal's strategic value to Stripe, not simply the depressed valuation the public market has recently assigned to the company. If the acquisition price reflects that strategic value, I believe Stripe should have to pay a fair premium for PayPal, and shareholders should not accept a price that undervalues the company. I don't want to spend too much time on Advent's side, as that side is probably more about a private equity firm allocating capital into what they see as an opportunity. But given that it looks like this could be a 50-50 venture between Advent and Stripe, I do think we should talk about what Advent might get out of this deal. Advent is a private equity firm, and they've invested in payment companies in the past, as you can see from this slide, although none would be at the size and scale of what they would be doing with PayPal. And Advent may feel that PayPal's performance could be improved under private ownership while they benefit from PayPal's cash flow generation. Okay, all that said, PayPal is a turnaround story as it has faced operational challenges. The second quarter results provide a good example of both the strengths and the weaknesses of the business. Total payment volume grew 10% to approximately $486 billion, or 9% if you exclude the effects of currency movements. But revenue only grew 5%, and actually only 3% when you exclude the currency movements. So PayPal is struggling to convert total payment volume increases into proportional revenue growth, which is a sign of pressure on the business. This pressure on the business becomes even more noticeable when we look at transaction margin dollars. Transaction margin dollars represent the revenue remaining after subtracting transaction expenses and transaction and credit losses. PayPal generated $3.9 billion of transaction margin dollars during the quarter, but that was an increase of only 1%. Excluding interest earned on customer balances, transaction margin dollars increased 3%. Meanwhile, non-GAAP operating income declined 8%. Non-GAAP operating margin fell 248 basis points to 17.4%, and non-GAAP earnings per share declined 1% to $1.38. Part of that decline was due to a 9% increase in non-transaction related expenses as PayPal spent more on technology, risk management, and other business investments. In short, PayPal is not converting its payment volume growth into revenue and profit growth at the same rate. Part of the reason for this is that branded checkout, which is essentially when someone clicks on the PayPal button and uses PayPal at checkout, is not growing very quickly. Branded checkout payment volume grew only 2%, excluding currency movements. This is especially important because branded checkout generally has a higher take rate than PayPal's unbranded checkout business, which includes Braintree. User growth is another concern. PayPal finished the quarter with 439 million active accounts, which was essentially unchanged from the previous year. Monthly active accounts increased only 1% to 228 million. International performance was another weak spot. On a currency neutral basis, international payment volume was essentially flat, and international revenue actually declined 3%. All that said, there are bright spots. Transactions per active account, excluding unbranded processing, increased 7%, indicating that existing PayPal and Venmo users are transacting more frequently. Remember that I mentioned PayPal's consumer facing network is one of the most important assets that Stripe would gain in an acquisition. Venmo's payment volume increased 14% to approximately $94 billion. Buy now, pay later volume increased 26%. Debit card and tap to pay volume grew by more than 60%. And monthly active accounts for Venmo debit card increased by more than 50%. Braintree payment volume also continued growing in the mid teens, which shows that PayPal remains competitive in enterprise payment processing, even if that volume generally carries a lower take rate than branded checkout. PayPal also generated approximately $1.8 billion of adjusted free cash flow during the quarter. For the full fiscal year, management now expects approximately $5.38 in non-GAAP earnings per share, more than $6 billion of adjusted free cash flow, and approximately $6 billion of share repurchases. So while the report is mixed, the business is still growing. Even with that margin pressure, PayPal generated a trailing 12-month GAAP net profit margin of approximately 14.4%. The balance sheet also remains strong when you compare cash and debt. So the next question is, what is the company doing to try to address the concerns of the market? And then what type of return could investors expect to get from the stock over the next several years should a buyout not happen? If we know this, we can then make some judgments about what shareholders should expect to receive if PayPal is acquired. Let's start with what the company is doing to try to turn things around. And before we get into this too much, I do want to stress that despite the fact that this is a turnaround play of sorts, PayPal is still a growing business with healthy margins and cash flows. Management has said that fixing PayPal's business will not happen overnight. In this section of the video, we'll discuss four things: business organization, prioritizing valuable customers, cost savings, and capital allocation. New CEO Enrique Lores has reorganized the business into three main units focused on checkout, consumer financial services and Venmo, and payment services and crypto. The company is also prioritizing its most valuable customers, with less than one third of its users generating more than half of its payment volume. Rather than simply chasing more accounts, PayPal wants existing customers to use more products, including Venmo, Buy Now, Pay Later, debit cards, and rewards. So they want to improve engagement with their existing customers to increase monetization of their existing accounts. There has been some early evidence of progress here, although branded checkout still needs to improve. In the past, I've hoped to see PayPal offer customers more incentives to engage with their platform, similar to what Robinhood has done to attract customers. While there are some rewards and cashback opportunities already, I would like to see them do more things like that. Cost savings are another important part of the plan. PayPal is targeting at least $1.5 billion of gross annualized run rate savings over the next 2 to 3 years, including approximately $400 million by the end of 2026. Those savings are expected to be from simplifying and improving the efficiency of the business and from using more artificial intelligence and automation. I should point out that not all of this cost savings is likely to translate directly into increased profits, as PayPal plans to reinvest part of those savings into technology, checkout, Venmo, and other growth initiatives. But the hope would be that the reinvestments would lead to growth, stronger margins, and additional profit. The final part of the turnaround is capital allocation. PayPal expects to generate more than $6 billion of adjusted free cash flow during fiscal year 2026 and plans to spend approximately $6 billion on share repurchases. During the second quarter alone, they repurchased approximately $1.5 billion of stock and paid around $125 million in dividends. Over the trailing 12 months, PayPal's repurchases helped reduce its weighted average share count by approximately 10%. And that share count reduction is important because PayPal can increase earnings per share even if its overall net income grows more slowly. If there are fewer shares, that means the overall earnings of the company are divided among fewer shares. Now, that said, the higher the share price rises, the fewer shares PayPal can repurchase with the same amount of money. So that is why my valuation, which we'll get into shortly, I use a different average share repurchase price for each year. So there is execution risk with PayPal's turnaround strategy. Can they improve branded checkout? Can they deliver the targeted cost savings? Can they continue to grow consumer products like Venmo and monetize them? These uncertainties help explain why the market has assigned PayPal a lower valuation. At the same time, the company continues to generate substantial free cash flow, maintains a strong balance sheet, and can return capital to shareholders while investing in the turnaround. Stripe and Advent would be acquiring the potential turnaround and the present cash generation by acquiring PayPal's business. If PayPal can create that value independently, shareholders should not give all the potential upside to a buyer at a price that primarily reflects the company's current problems. So, with the turnaround plan and the capital allocation strategy in mind, let's take a look at what PayPal could be worth if it doesn't get bought out by another company. Here I have a valuation model for PayPal stock going out to the end of fiscal year 2030. I'm assuming 4.6% revenue growth for this fiscal year, and then I'm assuming the growth rate declines to as low as 3.5% in future years over time. I'm also assuming a normalized net income margin of about 3.5%, with this fiscal year's being slightly higher to have the EPS guidance line up. And this is lower than the trailing 12 months, but I think this is fair because PayPal is investing in its business and is facing some take rate pressure. A big part of this investment is the assumption that there will be the return of capital and share buybacks. So I'm assuming PayPal's management continues to buy back $6 billion of stock each year. I did not increase or decrease this amount. Now, the price at which they can buy back stock is also influenced by what the stock costs on the open market. So I'm also assuming some multiple expansion to 13 times normalized earnings, actually by the end of this fiscal year. And then going forward, I'm assuming that the stock trades at 13 times normalized earnings. I also separately assumed an average share repurchase price for each year, and that allowed me to estimate how many shares could be repurchased each year. I also accounted for potential dilution each fiscal year, as PayPal does do stock based compensation. Using this model, I have an implied share price of $111.47 after fiscal year 2030. With some dividends factored in, which included assumptions for dividend growth, I'm assuming shareholders could expect an implied 2030 year end share price plus dividends of $114.72, which represents an implied total return of over 86% in less than 4.5 years, based on the closing price from Friday, August 14th, 2026. With January 1st, 2031 as the end date, this would imply a compound annual growth rate of over 15%. It's important to remember that this model estimates PayPal's value at the end of 2030. The projected $111.47 share price cannot simply be treated as the minimum price shareholders should accept today, because receiving cash today eliminates several years of waiting and execution risk. And at the same time, this model may prove conservative if PayPal achieves faster growth, stronger margins, or a higher terminal multiple. A higher share price would also reduce the number of shares that PayPal could repurchase, but greater earnings growth or multiple expansion could still produce a higher overall return. The potential upside and the strategic value available to a buyer should also be considered when evaluating an acquisition offer. So, what would I like to see as a shareholder? I think the minimum price I could accept and be reasonably happy would be $90 a share. Now, that is partially influenced by the prices that I paid for shares and for the options that I have, but also in considering the valuation and what I think the upside is over the next couple of years if PayPal does not sell the business. At $90 per share, a buyer would be paying approximately 16.7 times PayPal's 2026 non GAAP earnings guidance, which doesn't seem particularly expensive considering the potential benefits for Stripe. I realize that that would be a pretty significant premium to the current market price, but market prices can change quickly. And I think the underlying value of PayPal as a business is not properly represented in the current market price. I do think that $85 is a reasonable absolute floor for what PayPal management should be willing to accept. I think below those numbers, you're giving away too much upside and too much return of capital over time. This company still generates and returns a ton of cash flow, and there are still parts of the business with significant upside that should be considered here. If you want my honest hope, it's that the story came out on Friday because PayPal management is trying to get a second bidder involved to try to create a bidding war, similar to the one that happened for Warner Brothers when Netflix and Paramount were going back and forth trying to acquire that company. So I have no evidence of that being the case, but that's my hope. And I do have to believe that if the company is undervalued, that there will be more than one potential buyer that's interested. So I guess we'll have to wait and see what happens, but I'd like to hear what you think. So please let me know down in the comments what you think and if you think that I'm way off base here. I don't think that just because a stock is priced at a discount in the public markets that the actual value of the company is being properly represented, especially in a situation where it's taken private and there is complete control and the potential for operational synergies like there are in this case. So again, let me know what you think in the comments. I'd love to hear from you and have some conversation about this. If you found the video helpful or informative at all, please click the like button, subscribe, click the bell to get notifications, and follow me on X at Stock Sale Flyer, where I post about what I'm buying and selling in the market a lot of the time and also give other opinions on the market. I do appreciate you watching all the way to the end of the video, and I hope to see you in another video. Take care. Bye.